Silver just experienced its worst single-day crash since 1980, a 31% collapse in one session, from $122 to $78. Gold dropped 12% on the same day, the steepest decline in over 4 decades. $15 trillion in paper wealth vanished from precious metals markets in 48 hours. And right now, while everyone is panicking, while the financial media is declaring the end of the precious metals bull market, while retail investors are liquidating their positions in fear, something else is happening, something the mainstream is completely missing. 3 signals are flashing that I've only seen twice before in my 35-year career, 1971 and 2008. Both times, what came next changed everything, but this time, the numbers are bigger, the debt is deeper, and what silver is about to do will catch 95% of investors completely unprepared. Subscribe to this channel right now, because what I'm about to show you will fundamentally change how you view the next 12 months. Let's begin. Part 1. What just happened? The anatomy of a crash. It's February 2026. Silver sits around $80 per ounce. Gold has pushed beyond $5,000. Just 3 weeks ago, silver was trading above $120. It had rallied 250% over the past year, the strongest performance since 1979. Then on January 30th, everything broke. President Trump nominated Kevin Warsh as the next Federal Reserve Chair. Warsh is known as a hawk, someone who believes in tighter monetary policy and a smaller Fed balance sheet. The market interpreted this as the end of the debasement trade, and the selling began, not gradual selling, violent, cascading liquidation. The CME Group hiked margin requirements 36% for silver futures and 33% for gold. Leveraged traders who couldn't meet margin calls were forced to liquidate. Stop losses triggered more stop losses. Algorithms amplified the selling. Silver dropped from $122 to $78 in essentially 2 trading sessions. It briefly touched $64, down 47% from its high. The headlines screamed, historic crash, silver bubble bursts, safe haven assets no longer safe. But here's what the headlines missed. The eShares Silver Trust SLV saw $3.5 billion in sell orders on January 30th alone. Over $7.6 billion has fled the ETF since then. Where did that silver go? It didn't disappear, it changed hands. While paper holders were panic selling, physical buyers were accumulating. Bullion dealers reported record premiums during the crash. Industrial users who had been priced out at $120 stepped into secure supply at $64. The crash to $64 and the subsequent recovery to $80 suggest that the market has finally found a price that balances speculative interest with industrial reality. The speculative froth has been purged, but the structural fundamentals, they haven't changed at all, and that's what most people don't understand. Part 2. The Everything Code. Why silver matters now. Let me explain why I'm talking about silver when I normally focus on crypto, because silver is telling us something important about the Everything Code. For those who don't know, the Everything Code is my framework that explains why all asset prices move together. The master variable is global liquidity. When central banks expand their balance sheets, when governments inject money into the system, asset prices rise. When liquidity contracts, prices fall. Gold and silver are the original hard money, the assets that existed before fiat currencies, before central banks, before the entire monetary experiment we've been running since 1971. When these metals move violently, it's usually a signal of deep structural stress in the financial system, not surface stress, not the kind that shows up in quarterly earnings reports or GDP numbers, deep structural stress. And right now, 3 critical indicators are flashing simultaneously. Signal number 1, the gold to silver ratio. There's a number that serious macro analysts watch closely. It's called the gold to silver ratio. You take the price of gold, divide it by the price of silver. That number tells you how many ounces of silver it takes to buy 1 ounce of gold. For most of modern history, that ratio has stayed between 60 and 80. When it goes higher above 90 or 100, it usually means economic fear is rising and investors are rushing into gold as the ultimate safe haven. When it goes lower below 60, it means something different. It means silver is outperforming. And silver only outperforms gold when 2 things are happening simultaneously. First, there is monetary instability. People don't trust their currency. They're moving into hard assets. Second, there is industrial demand. The economy is still running, still consuming, still producing. Right now, in February 2026, that ratio has dropped to around 63, compressed nearly 45 points from April 2025's extreme of 100 to 1. That combination, monetary fear plus industrial demand, is rare, and historically it doesn't last long, because one of those 2 forces always breaks, either the industrial economy slows down and silver falls harder than gold, or the monetary system breaks down further and both metals explode higher. The question facing every investor right now is simple: which one breaks first? Signal number 2, the central bank accumulation. Central banks around the world have been buying gold at record levels. Not just any central banks, the ones that matter: China, Russia, India, Turkey, Poland, the countries that are quietly moving away from dollar dependence. China's central bank has been buying gold for 15 consecutive months. They're not buying because they love shiny objects. They're buying because they don't trust the system that has been in place since 1971. Goldman Sachs just reiterated their year-end gold target of $5,400 per ounce, and they're saying central bank buying will re-accelerate through the year. But here's what most people miss. While central banks can't officially hold silver the way they hold gold, they're watching it, because silver sits at the intersection of money and technology. Signal number 3, the structural deficit. The silver market has been in deficit for 6 consecutive years. What does that mean? Total demand exceeds total supply every year for 6 years running. Inventories are falling. London physical supply is tight. Mines take years to develop. Recycling cannot fill the gap, and demand isn't slowing, it's accelerating. Solar panels require silver. Electric vehicles require silver. AI data centers require silver. Medical devices require silver. Electronics require silver. Every technological shift of the exponential age requires more silver. When supply tightens and demand stays strong, prices rise. But when that happens during a period of monetary instability, prices don't just rise, they spike. Part 3. The 3 pillars that are cracking. There's an old engineering principle that most people never think about. When a structure fails, it rarely fails all at once. It fails in stages. First, one support beam cracks, then another begins to bend, then a third starts to buckle. And for a while, sometimes for months or even years, the structure holds. People walk through it every day. They see nothing wrong. The lights are on, the doors open, everything looks normal. Until one morning, one final pressure point gives way, and the entire thing comes down in seconds. What looked stable yesterday is rubble today. The global financial system works the same way, and right now, in February 2026, 3 critical support structures are cracking simultaneously. Pillar number 1. The money illusion. Since 2008, central banks have been running an experiment never tried at this scale in human history. They've created money, trillions of dollars, euros, yen, not by printing physical bills, but by creating digital entries in computer systems. The theory was simple: create enough money, and people will spend it. Spending creates demand. Demand creates jobs. Jobs create growth. Growth solves everything. But there was a problem the central bankers didn't talk about publicly. When you create money without creating real value, without creating actual goods and services, you don't create wealth, you create debasement. This is what I call the 11% hurdle rate. Governments are debasing currency at approximately 8% per year to manage sovereign debt. Add measured inflation of roughly 3%. That gives you an 11% minimum return just to maintain purchasing power. Any investment returning less than 11% annually is actually making you poorer in real terms. When people lose faith in money, they move into things that cannot be printed: gold, silver, Bitcoin, real assets. That migration has already begun. The question is not whether it continues. The question is how fast. Pillar number 2. The debt that cannot be paid. There's a number that almost no one talks about in polite conversation. The total debt of the United States government, including all the promises made for Social Security, Medicare, and pension obligations, is not $34 trillion. That's just the official number. The real number, when you include unfunded liabilities, is somewhere north of $150 trillion. The entire US economy produces roughly $28 trillion per year. Europe is in a similar position. Japan's debt to GDP ratio exceeds 260%. This is not a problem that gets solved with economic growth. Even if every major economy grew at 4% per year for the next decade, which is wildly optimistic, the debt would still be mathematically unpayable. So what do governments do when they cannot pay their debts? History gives us 2 options. Option 1, default, admit the debt cannot be paid, restructure, wipe out creditors, cause massive economic pain. Option 2, inflate, keep printing money, pay back the debt with currency worth less every year, slowly steal from savers through invisible taxation. Guess which option governments always choose? By February 2026, inflation is not a bug in the system, it is the strategy. And when inflation is the strategy, hard assets become the defense. Pillar number 3. The world that is splitting. There's a shift happening in global power structures that most people are not paying attention to. For 70 years, the world operated on one basic system. The US dollar was the reserve currency. Oil was priced in dollars. International trade was settled in dollars. That system gave the United States enormous power. It could print money and export the inflation. It could impose sanctions and cut countries off from the financial system. But that system is fracturing. China and Russia are settling trade in their own currencies. Saudi Arabia is accepting payment for oil in yuan. India is buying Russian oil with rupees. The BRICS nations are building alternative payment systems. Central banks that used to hold 70% of their reserves in dollars are now diversifying into gold, euros, yuan, anything not solely dependent on US policy. When countries see the US weaponize the dollar, freeze Russian reserves, sanction nations at will, they realize the same thing could happen to them, so they prepare. And the way they prepare is by moving into assets that no single government controls. Gold is the obvious choice, but silver. Silver is something different. Silver sits at the intersection of money and technology. It's both a monetary metal and an industrial commodity. In a world splitting between competing power blocks, the countries that control silver production, the companies that secure silver supply chains, the investors who position early, they will have leverage. Part 4. WH silver is about to do. Now let me tell you what most analysts are getting wrong. The crash from $122 to $64 was not the end of the silver bull market. It was a purge. The speculative excess has been eliminated. The leverage has been flushed out. The weak hands have been forced to sell. What remains is the structural case. The Silver Institute just released their 2026 outlook. Key findings: silver is expected to remain in deficit for a sixth consecutive year. Elevated geopolitical tensions continue to support precious metals investment. Physical tightness in London has further amplified upward price momentum. Industrial demand from AI, solar, and EVs continues to benefit from favorable structural growth trends. The analysts who were bullish at $120 like Peter Brandt and JP Morgan's Marko Kolanovic have acknowledged the move was extreme, but both are now saying the same thing: 2026 is not 2011. In 2011, silver collapsed from $50 back to $15 and stayed there for years. But 2026 is different. The structural deficit didn't exist in 2011. The industrial demand from the exponential age didn't exist in 2011. The central bank accumulation didn't exist in 2011. Silver may not need to collapse back to long-term lows. Instead, it may be entering a multi-month digestion phase with violent swings in both directions. UBS forecasts silver will return to $100 by next month, then settle around $85 by year-end. Goldman Sachs remains bullish on gold at $5,400, and historically, silver follows gold's moves. But here's what I think most people are missing. The gold-to-silver ratio at 63 is compressed but not at historical extremes, when the ratio has fallen below 50 in the past, as it did briefly in January when silver hit $120. It has marked a period when silver is relatively expensive, but when the ratio is between 60–80. That's the normal range. Silver can move significantly in either direction from here. The key variable is liquidity. And we have $10 trillion in US government debt that needs to be refinanced in 2026 to 2027. That's on top of corporate debt refinancing. That's on top of commercial real estate's refinancing wall. When that liquidity comes, and it must come, the math demands it. Hard assets benefit. Gold, silver, Bitcoin, Solana, SUI. The assets that cannot be printed will outperform the assets that can. Part 5. The 3 scenarios and how to position. Let me give you my framework for thinking about what happens next. When markets reach inflection points like this, when multiple systems are under stress at once, the future doesn't follow a straight line. It branches. There are 3 possible paths forward from here. And the critical skill that separates those who survive from those who thrive is understanding all 3 paths and positioning for whichever one emerges. Not prediction, preparation. Scenario number 1. The slow burn. In this scenario, central banks manage to keep the system intact. Inflation stays elevated, not catastrophic but persistent. 4%, 5%, maybe 7% in some years. Interest rates stay higher than the 2010s but lower than the 1980s. The dollar weakens gradually. Gold and silver drift higher over years, not months. This is the path most economists are expecting, the soft landing narrative. In this scenario, silver probably trades in a range of 75–100 through the year, volatile but not explosive. The strategic move: own hard assets that appreciate with inflation, real estate in the right markets, commodity-linked investments, precious metals as a hedge, and yes, crypto, Bitcoin, Solana, SUI for asymmetric upside. Scenario number 2. The sudden break. In this scenario, something breaks fast. A debt crisis in a major economy, a currency collapse in an emerging market that spreads, a geopolitical event that disrupts energy or food supplies, or simply a loss of confidence in central banks' ability to control the situation. When confidence breaks, markets don't fall gradually. They gap. currencies collapse in days, not years. Inflation doesn't drift higher, it explodes. This has happened before. Argentina 2001, Turkey 2018, Venezuela 2016. In this scenario, silver doesn't just rise, it spikes, potentially back above $100, potentially higher. And in this scenario, the companies and individuals positioned in hard assets don't just survive, they thrive. Because while everyone else is scrambling to protect what they have, the prepared ones are buying assets at distressed prices. Scenario number 3, the deflationary shock. There's a third path that fewer people talk about. In this scenario, the debt burden becomes so overwhelming that the system cannot inflate its way out. Credit contracts, spending freezes, asset prices fall across the board. This is what happened in the 1930s. It's what nearly happened in 2008 before central banks intervened. If it happens again, silver has a problem because silver is not just a monetary metal, it's an industrial commodity. If the economy collapses, industrial demand collapses, and silver falls, possibly harder than gold. In this scenario, cash and liquidity win, the position that works in all three. Here's the uncomfortable truth. No one knows which path we're on, not the Federal Reserve, not the smartest economists, not the biggest hedge funds. Anyone who tells you they know for certain is either lying or delusional. But that does not mean you do nothing. It means you position for uncertainty. What works across all three scenarios? First, reduce unnecessary debt. In inflation, debt gets easier to pay, but your income may not keep pace. In deflation, debt becomes a death trap. Second, build operational flexibility. Businesses that can pivot quickly survive shocks. Those that are rigid break. Third, diversify income streams. Single points of failure are dangerous in unstable times. Fourth, own some hard assets. Not all in, not reckless, but enough that if paper currencies lose value, you're protected. For me, that allocation is roughly Bitcoin, foundation, hardest money, 30% pullbacks, Solana and SUI, higher risk or reward. Network effects, 50-65 pullbacks, gold, insurance, survives every scenario, central bank accumulation. Silver, industrial plus monetary dual role, more volatile than gold, currently at $80 after the crash. Fifth, stay informed. The people who get destroyed in economic resets are not the ones who lack resources. They are the ones who stop paying attention. Part 6. The window that is closing. Let me be direct about what I'm seeing. Silver crashed from $122 to $64. It's now trading around $80. That crash purged the speculative excess, the leverage is gone, the weak hands are out, but the structural case, the supply deficit, the industrial demand, the monetary debasement, none of that has changed. The gold-to-silver ratio at 63 is historically normal, not extreme in either direction, which means silver is neither obviously cheap nor obviously expensive right now. But here's what is obvious. The debt wall hits in 2026 to 2027. $10 trillion in US government debt must be refinanced. The math demands liquidity injection, and when that liquidity comes, it will flow to scarce assets. We're already seeing the setup. The Supreme Court just struck down Trump's global tariffs, which will boost the US budget deficit further. The Fed is expected to cut rates at least twice this year. Central banks are accumulating gold at record pace. The conditions that drove gold from $2,000 to $5,000 haven't disappeared, they've accelerated, and silver, historically, follows gold, but with more volatility, more upside, more risk. The silver price crossing $80 is not the cause, it is the symptom, it is the market's way of saying something fundamental is changing, closing. The telegram you're sending, there's a story I think about often. 2 salesmen were sent to a remote island to assess the market. The first salesman arrived, looked around, and sent a telegram back to headquarters. Situation hopeless. No one here wears shoes. The second salesman arrived at the same island, looked around, and sent a different telegram. Opportunity unlimited. No one here wears shoes yet. Same island, same facts, completely different conclusions. The difference was not in what they saw. The difference was in how they saw it. Right now, the global financial system is that island. Most people are sending the first telegram. Situation hopeless. Everything is breaking. Silver crashed 31%. Bitcoin dropped 46% from its highs. The leverage is being flushed. The volatility is extreme. But there's a small group, the strategic thinkers, the prepared ones who are sending the second telegram. Opportunity unlimited. Everything is resetting. The question is not whether change is coming. The question is, which telegram are you sending? In every economic reset throughout history, there have been two groups: those who see it coming and those who don't, those who position early and those who react too late. The price on the screen is just a number. The real story is what that number represents: a system under pressure, a world in transition, an opportunity for those prepared, and a disaster for those who are not. The warning has been given. What happens next is up to you. Subscribe to this channel, hit the notification bell, because the next 18 months will determine who builds generational wealth and who watches from the sidelines. The magic is out there. You can do it your way. Don't F this up.